Welcome you all to this learning video that we're going to discuss about the first chapter of business finance. In this chapter, we're going to introduce about the corporate finance, what are the definition and what is the benefit that you can apply this knowledge in your real life, in your career, in your organization. So the concept that we're going to discuss in this chapter will be about the type of the financial management decision, the role of the financial managers. You're going to discuss about the different forms of the business organization. We can discuss about the short-term and the long-term goal of the financial management. And then later on, we're going to discuss about the topic called conflict of the interest that can arise between owners and managers, or simply principal and agent relationship. And we're going to discuss about the types of the financial markets. So here is our chapter outline. We're going to discuss about the corporate finance and the role of the financial managers. This one is a very attractive career in the real organizations. We're going to discuss about the forms of the business organization. For example, partnership. For example, company limited company. We're going to discuss about the goals of the financial management and agency problem, as I told you, the principal and agent relationship. And finally, we're going to discuss about the financial management and the corporation. So the one who is working in the field of the corporate finance is mean finance in the organization. So the word corporate finance combined from the two words corporate, it mean corporation, it mean organization, as well as finance that talk about money. So the people who is working in the field of the corporate finance basically look at the long-term investment. Should we invest in some project? Should we invest in some business? The long-term investment will be a long-term commitment of the company. If you imagine you invest in the ice cream factory, it means that you have to manage that asset for a long time. So why the people in the corporate finance, they need to take care of the long-term investment? Because basically long-term investment define the company future. So this is the first topic that the corporate finance people basically take some decision, make some analysis to analyze whether that long-term investment is good or not. The second question is we're going to discuss that where we're going to get the long-term financing to pay for the investment. Later on in this subject, you will learn about what we call capital structure. So the capital structure defines the appropriate percentage of debt and equity. Assume that you're going to invest 100 million baht in some business and you have 70 million for the equity. So you need to borrow or make a loan for 30 million baht. So in terms of the long-term financing, you need two portions. The first portion is the portion from the equity. The equity is mean the money from the owner. And the second part is the money from loan. Okay, so it means where are we going to get a long-term financing to support such projects? And then the third question, we're going to discuss about how to manage everyday financial activity. Remember, when you work on some business, you have a cash payout and you have a cash receive. So in this topic, it means that the corporate finance managers, they need to deal about day-to-day operation in terms of finance, in terms of money. Sometimes we refer this concept to working capital management. Okay, so here are some examples of the three questions that basically corporate finance we are looking for, and we try to analyze and come with the best option for the company. So as I have mentioned to you about those three questions, Those are the basic questions that financial manager basically do. So the financial managers try to answer some of those questions. But in reality, there are a lot of questions that comes to the financial managers. The previous list, there are just some example that the financial managers, they have to deal in their career. When you look in the term of the finance career in the organization, basically the top management will be called Chief Financial Officer or CFO. So if you hear the word CFO in the organization, it means that he is the top executive. He or she is a top executive in terms of the finance function in the company. So when you see the word finance, it usually comes with the word accounting. So if you have a look in this slide, you will see the word treasurer and the word controller. So treasurers, they oversee cash management, credit management, capital expenditure, and financial planning. So we can say that treasurer is taking care of the finance function in the company. Cash management means managing cash in the company, and that will be some liquidity issue. Credit management is mean that if your customers want to buy your product, you may give them some credit. It means that they can buy the product and then they can pay the money to you later on. The word capital expenditure or CapEx, this keyword means investment. So if you are interested to invest in some company, invest in some project, we say that that is the capital expenditure. And the word financial planning is mean that you plan for the finance for the company for the long term and the short term. So you can see that what I have mentioned is about the treasurer. So the treasurer basically taking care of the financial tasks in the company. Then another keyword is the controller. Controller oversees tax, cost accounting, financial accounting, and data processing. So you can see that controller basically taking care of the accounting tasks in the company. Okay, so treasurers means finance and controller means accounting. Okay, finance taking care of the cash, finance taking care of the financial planning, controller taking care of the accounting, financial statement. Okay, so basically these two guys, they are part of the CFO supervision. Okay, so here is the attractive job opportunity for us in the future. So we discussed about the treasurer and we discussed about the role of the controller. In this slide, we can discuss about some additional concepts. Finance managers, they usually make several decisions regarding to the finance of the company. Here is some example. Capital budgeting. So if you are interested to invest in some project, you are interested to invest in some business, we need to quantify whether that business is attractive or not. We say that this is the capital budgeting. You plan for the long-term investment for the company. You plan to invest in the new building. You plan to invest in the new factory. This kind of the task need a very detailed financial analysis to quantify whether that business is good or not. The second financial management decision is about the capital structure. How should we pay for those investments? How should we pay for those assets? I would like to give you some example that might be very close to our daily life. Imagine that you are interested to buy a new car and that car costs 1 million baht. You have just 700,000. So you need another 300,000. So you plan to make a loan from the bank for those 300,000. In this case, this is the capital structure that you're gonna buy that car. Okay, so capital structure means the composition of debt and equity. So this is the real life of the finance managers to decide whether how much for the equity that they have and how much for the debt portion that they should borrow. Okay. The third financial management decision that we're going to discuss in this chapter is about the working capital management, or basically the short-term finance that you need to manage, you need to run the business. Remember, if you open a milk tea shop, you have to pay for the raw material and then you collect your money from your customers. So you need some money to put in the business to manage the day to day. Okay, basically you pay your money out before you receive your money in from the customer. So working capital is the cash that circulate around your company to help you to manage day to day, to pay the bill, to pay the salary, to pay your raw material. Okay, so here are some examples that the finance managers they basically make some decision. So right now, I hope that you have a clear understanding on how you look at the finance task in the company. Okay, so from now on, we're gonna discuss about the business organizations forms. Basically, we're gonna discuss about the three types: the sole proprietorship, partnership, and corporation. Okay, the first type is the sole proprietorship. Basically, we can say that this is the single owner for the business. Okay, if you own some company for just one people, so the advantage is very easy to start. Okay, you are the owner, you do the business on your own. This is a single owner that keep all profit. Okay, and since this one is not a form of the corporation, this is not a form of the company, so you treat those income as a personal income. Okay, you do business on your own, you didn't register for the company, you didn't register for the partnership, so it depends on the owner. The disadvantage is that the most important thing is that this is unlimited liability. So if you do something, you have to responsible for that. Okay, and it is difficult to expand, it is difficult to sell some ownership to the investor. The second type is the partnership. You partner with someone and you register for the partnership. So you can team up with others. It is relatively easy to start. Income once taxed as a personal income. Okay. But the disadvantage is that it have unlimited liability. So the partner they need to responsible for the liability. And then partnership dissolve when one partners die and it is difficult to transfer the ownership. Okay, so if you want to set up some business, we can set up a partnership together between you and me, for example. But the last one is the one that is widely accepted around the world. This is a corporation. So any company, any public company in the stock market, they are the corporation. The advantage is that they limit liability. It means that they will responsible for such a level of the liability. Okay, it separates the ownership and the management. If you look at some company, the owner are a group of people that employ or hire the management to work on behalf of them. It is very easy to transfer the ownership. You want to sell the share to other people. You want to have some investor to invest in your company. So the corporation is the one that it is very flexible and it can do many things. It's also easy to raise the capital. But the disadvantage is that it have the issues called double taxation. So once the company report profit, they need to pay tax. And once they pay the dividend, the receiver of the dividend need to pay tax once again. Okay, but the dividend tax, it depends on each country. Okay, so we discussed about the sole proprietorship, we discussed about the partnership, and we discuss about the corporation. So from now on, let us discuss about some goal of the financial management. So someone might think that, oh, we talk about finance, we talk about numbers. What are the goals? So have a look in this list. Maximize profit, minimize cost, maximize market share, maximize the current value of the company's stock. So all of them, I would like you to think in the two perspectives, in the short term and in the long term. You might hear that some executives they try to maximize profit in a short run that will harm the company in the long run. Okay? So the goal of company is to maximize shareholder value in the long run. In the long run. So you might hear some case that some CEO they try to maximize the profit and then they leave the company. That is the short run perspective. So whether you have some financial decision, some business decision, make sure that you focus on the long term. Okay. Basically, profit, cost, market share, current value of the stock price, they are the indicator of the company wealth. But remember, we should focus on the long run of the company. Okay? Maybe in the short run, it is not a maximized profit, but we believe that decision will help the company in the long run, so we make that decision. So as I mentioned to you, why we need to talk about the agency relationship. Okay, why we need to talk about this agency relationship? Recall the topic that we discussed in terms of the corporation. You set up the company. So the company, one of the characteristics is that they they separate the ownership and the management of the company. Think about some large public company in Thailand, for example, PTT, CPO. The owner are the shareholder, but they employ the board of director, they employ the CEO to work on behalf of them. So in terms of the corporation, the owner is separate from the managers. So the agency problem arises from this relationship. We say that the owner of the company is the principal, and the managers of the company, we call them agent. So principal hires an agent to work on behalf of them. Okay? Stockholder, the owner, the principal, they are the same person. The agent, the managers, the executive, they are the same person. So imagine in this case, the company hire me as a CFO. So I look for a luxury car. I look for a beautiful office. When I fly overseas, I fly with the first class air ticket. You see? So this is a conflict between the principal and agent. Principal, they look to maximize the value of the company, but the agent, they look for their return. They look for their salary. They look for their benefit. Okay, so the agency problem is conflict between principal. The principal want these managers to work the best on the company money, but the managers they have their own interests. Okay, so here is the agency problem. That's why in the modern finance world we need to manage and we need to control this thing. Okay, remember, principal they look for their wealth and agent they look for their benefit and salary. Okay, so you need to weigh between agency cost, it means the cost that you're taking care of those managers as well as the goal of the organization. Okay, here is the agency problem. um, so in fact there are several techniques, to manage those managers. For example, managerial compensation. Okay, you should align the benefit of those managers with the goal of the organization. Okay, and the incentive should be structured carefully to make them achieve the goal. If they do their job very well, you give them benefit, they are very happy with their benefit, and then they work very well with the company. So here is how we manage principal and agent relationship. Okay, if they didn't do their job very well, maybe there might be some threat of takeover from competitor from other company. Okay, so this is something that we can manage those people. So by the end of this topic, I would like you to understand what is the principal and agent relationship. Okay, each of them, they have a different goal, they have a different needs. So I hope that at the end of this chapter, you understand the three types of the financial management decision. Okay, you understand about the forms of the business. You understand about the long-term and short-term goal of the financial management. You understand about the agency problem. Okay. In terms of the market, we can discuss in the following chapter. Thank you so much for watching this clip and see you in our class.